Hi dreamers, today I'm going to go through two high yield funds. One that has a yield of over 13% and another that has a yield over 17%. And what's interesting about the two funds that I'm going to cover today is that not only do they have high income paid monthly, but also tax advantage strategies that allow you to capture the growth without NAV erosion. Is that even possible? Well, buckle up, my dreamers, because today we're going to take a look at two of the funds offered by KURV. Here we go. All right, well, here we are at KURV's website, and the two funds that I want to cover today are GOOP, based on Google, and AMZP, based on Amazon. And these two funds act and are managed in the exact same way, so let's cover them, starting with GOOP. So you can see here it has a 13.25% distribution rate, and down over here you can see the expense ratios at about 1%. And so how do they provide that premium strategy? Well, as they describe it, they generate a monthly cash flow through different sources, including harvesting covered call option premiums, dividends, and interest. They also talk about the benefit of dynamic optimization, where they balance the fund between generating income versus capital appreciation based on market conditions. They also mention here that another benefit is a tax advantage, because option premiums may not be immediately taxed and therefore has the potential to offset short-term tax liabilities. And if you go to AMZP, you'll see the exact same language. And just so you know, they have other single stock funds just like this based on Apple, Microsoft, Netflix, and Tesla. But just to keep this simple, I want to explain exactly what they're doing so that you can make a determination on whether or not you like the risk to reward profile of these two funds. So starting with GOOP, if I scroll down to take a look at the holdings, you can see the holdings right here as of 9/16/2025. And basically what you see are treasury bills and cash. And then essentially, you'll see these options plays with Google calls and Google puts. And if you look at the Amazon holdings, you'll see the exact same thing with cash holdings and treasuries, and then synthetic options through calls and puts. So let's dig into that a little bit to see exactly what they're doing. So first, let me explain quickly the difference between a synthetic option and holding the underlying stock. So in this setup, what KURV is doing to create a synthetic position is that they'll buy a call option and sell a put option at the exact same time. And one of the benefits to them is that it requires a lower initial capital outlay. But one of the downsides in creating a synthetic position is that you do not receive the dividends and have no voting rights. And another major downside of this is that it's very complex and requires a lot of knowledge and management of these kinds of options. And so setting up synthetic positions is something that I wouldn't recommend to the average investor, which might be a reason to outsource this kind of complexity to someone like KURV. And one of the benefits is that it gives greater flexibility to adjust the positions as market conditions change. And so in terms of that flexibility, they aim to achieve better income than plain vanilla covered call ETFs by making adjustments to the expiry dates. They use contract rolling, and they use out-of-the-moneyness. Well, what does that mean? For example, the strategy currently writes 5 to 6 weeks from expiry, and the strikes are 5 to 15% away from where the underlying stock is currently trading. And as they state here, and I've also noticed in other funds, that this timing and buffer does provide a good balance between the price appreciation and the income premium that it generates. The other thing to note here is a good conceptual difference, and it's an answer to the question, is there an advantage to writing calls on single stock holdings versus an index? And as they say here, the answer is yes, that individual stocks tend to exhibit elevated levels of volatility compared to the indices such as the S&P or the NASDAQ. And as a result, call options on single stocks have higher implied volatilities, which can translate into higher premiums, and hence have better income generation potential. And based on my research, the other thing I like that they've stated is that the funds also have discretion depending on market condition to either create the synthetic options or actually hold the stock, which is another level of flexibility that allows them to optimize the best scenario based on the cycle and the market. And so now let's put this all together and see how this has performed. Well, here you can see over the past year, the S&P has had a total return of 18.53. And the NASDAQ has had a total return of 25.31%. And so here you can see the total return of AMZP at 27.61%, which has beaten the S&P and the NASDAQ. And then the total return of GOOP is just over 40%, which also has beaten the NASDAQ and the S&P. But I wanted to include the actual underlying stock so you could compare that. And what's interesting is you can see the return of Amazon here at just under 24%. Now in the past year, this underlying stock has not had a big growth spurt. And so in this case, AMZP did better because with that 5 to 15% buffer, it's been able to capture the growth plus add a bit of income and interest. And here you can compare just the Google underlying stock at a total return of 57%, which you can see just in the past month, an incredible growth spurt. And so as you can imagine, GOOP was able to capture the incremental growth pretty well along the way, but just in that past month was obviously capped. As the calls are 5 to 15% above, the growth in the last month was capped. And so I think those two examples of how incremental growth gets captured and exponential growth gets capped allows you to see that full picture of how the KURV funds are able to capture some of the growth while also generating a pretty high yield monthly, and gives you a nice balance of income generation that at the very least beats the indices of the NASDAQ or the S&P. Alright, so now we've talked about synthetic options, the discretion they have to either use those synthetic options or hold the underlying stock, and their use of out-of-the-moneyness to help capture some of the growth in addition to the income. Let's wrap up by talking about how they avoid NAV erosion and keep in mind taxes. So one of the things that they state overtly, which I really like, is that KURV distributes the cash flow generated by the premiums from selling covered call options rather than liquidating the fund's principal or net asset value to create those distributions. In other words, they will not use a portion of the principal to help pad a distribution. And in fact, they state that if they have excess 1 month, they will retain some instead of distributing it, and that being focused on making sure that there's no NAV erosion is actually one of KURV's priorities. Because, my dreamers, one of the cardinal sins of investing is holding a fund that erodes its own net asset values. And so I really like that KURV states it only harvests from the premiums. The other thing I really like about KURV is that they manage their options to be as tax advantaged as possible, focusing on after-tax total returns and managing the distributions in a tax advantaged manner. And one of the ways to do that is by potentially holding securities for longer periods to achieve long-term capital gains rather than short-term capital gains, which are taxed at higher ordinary income rates. And so my summary of these two funds is that you're able to reap the rewards of a higher income monthly payout with a pretty complex option strategy that you probably wouldn't want to manage. On top of that, you get a little bit of exposure to the growth of these individual funds, and also hold funds that have no NAV erosion. And so the sources of cash flow from these funds are from those options premiums, the capital gain growth, and also the interest from those treasuries that they hold. And I'd be remiss if I didn't talk about one of the major downsides. And the main one that I see is that obviously it's focused on one individual company. And so if you pick one of these and the underlying stock goes down over time, then obviously this fund will also follow that trend. But in general, as I look across these options, in particular, Amazon, Apple, Google, and Microsoft, I'm pretty bullish about those 4 companies into the future. And so as a longer term hold, I like the idea of adding some of these individual ETFs into the mix. Let me know what you think and if you have alternatives that are working well for you in the comments. Well, that's it for today. I hope you enjoyed this dividend income update. And if you want a richer real-time experience with me, you can always follow me on Instagram or X. And if you're doing your own research using Seeking Alpha, feel free to find the link below to subscribe if you want, no pressure. As always, I encourage you to do your own research, then implement and learn by putting it into practice. And as a reminder, I'm not a financial advisor, so keep in mind these videos are for entertainment and inspiration only. I'll see you on the flip side.